try to find some optimism here. We don't want anybody to leave depressed and running off to, again, continue with their shopping habits. But just a quick fire point of view from each of you. Are we glass half full, glass half empty with regard to the African narrative? And just exactly where are we with regard to this particular cycle?
I think from a property perspective, there's quite a few parallels that we can draw between what's happening in the commodity cycle and its impact on African economies, and draw parallels in terms of what's happening in the property sector. Over the last 10 years, we've had a huge amount of development in African cities. The skylines have changed dramatically. A lot of that development has been good. But as the economic tide is going out, I think it's going to leave some developers and some schemes rather exposed, because they probably haven't been built in a sustainable mindset in the first place. So I think this sort of period of change, with the change in the economic cycle, it always amplifies itself in the property cycle. And I think in property markets, in African markets, we're coming into our first property cycles. We can talk about sort of more specific markets and cycles in those markets as we see them. But I think if you take Nigeria as a case in point, they're coming off very high rents back in 2010, 2012, when there was very little office stock, and all the oil companies are rushing into that market. And you can see from Khanya's chart the levels of FDI that were flowing into the economy at that period of time that really stoked the property market and drove up rental levels. Now we get into a situation where a lot of supply is still coming through, but yet the occupier demand is dropping off as corporates taper back their requirements in these markets. And that's going to have a bearing on where rental levels sit and the viability of future schemes. But I think the point I want to make is with the cycle turning as it is, it's positive in the sense that it will really challenge developers to produce schemes that are sustainable in the long run. It will those developers or those investors that have not developed or invested in defensive assets that will be well conceived and well tenanted and built with sustainable values, that you'll find them falling away, and the sector will consolidate and be stronger for it. So I think it's just one of those phenomena that I think the African markets are experiencing for the first time, but it's positive as a result of what will come out of it, I think.
In other words, investors shouldn't be entering the continent to make a quick buck, is what I'm kind of trying to get away here, understanding.
Right, yeah, I think it's a long game in these African markets. When the first private equity funds were setting up in 2007, 2008, they were raising capital of 25 to 30% IRRs. Now we're seeing them raising of 18 to 25% IRR. So the whole return criteria for development in Africa is shifting in, which you'd expect as the market moves from a frontier to a more emerging market. But you have to look at this opportunity in African markets with very much a long-term mindset and be in it for the long run.
Well, I think in the short term, I'm more of a glass half empty type economist, in the sense that the pain that we're witnessing with the commodity super cycle almost coming to an end is something. It's a reality that most African economies won't be able to start off in the short term, because it does take a bit of structural work to actually change the growth model of some of these economies, and hence you see the likes of Zambia, Nigeria, etc. feeling the pain. So in the short term, the reality is that there will be pain to be felt. Unfortunately, that's the reality. But the upside, and this is where I'm a glass half full type economist, is that in the long term, the fundamentals are there, and I think Khanya did a very good job in highlighting the pockets of growth, and to a large degree, I agree with them in terms of where the growth are. Certainly, your Kenya, your Ethiopia, etc. Those are the models or the pillar of what most African economies should be in terms of export diversification. And I think you see that manifesting in the currency volatility that we're seeing East versus West Africa, right? So if you look at the Kenyan shilling, it's been relatively stable, and I emphasize relatively stable there, compared to the Naira, for example, the parallel market Naira, not the official Naira, where it's a tale of two stories, right? But the key point that I really want to put across there is that in the short term, you get policy risk, and by that I'm talking about that central banks and governments tend to institute policies that tend to be counterproductive in the short term. And I think a poignant example is in Nigeria, for example, where you're seeing the official rate being capped at 199, 200. And yet there's a fundamental disconnect between what is happening in the economy relative to where the currency is. More so, they are considering a two-tier FX type model where one sector of the economy has access to a certain rate and everyone else is buying dollars at like 385 or whatever the case is. So you get these short-term issues that tend to be counterproductive, or that rather tend to disconnect the fundamentals from what is happening in terms of the policy space. So you get some of these risks, and these are the things that you have to contend with as investors moving into Africa, which then brings the point to say that Africa is not a short-term play. It's not a tactical sort of region you get in and out to make a quick buck and go. Rather, you need to be boots and all, in the continent, and more importantly, you need call it bespoke solutions and to actually move into the economy. It's not something that you can do desktop research and then suddenly you are in Mozambique. You actually need to take considerable time to actually get in.
What we liked about in East Africa is that there was very deliberate planning and the execution of planning. If you look at, for example, South Africa, in terms of our planning, we're very good at that.
Implementation?
Implementation is the issue. So if you look at, for example, the Ethiopian government, right? They had a few plans, for example, to grow at a certain rate, to increase GDP per capita at a certain rate, to lower poverty at a certain rate, and all of that. And this was done, all these plans were put in place in 2004. They've achieved nearly every single one of their plans since 2004. And that's translated into growth. That's why they've been one of the fastest growing economies for the past 10 years. And that's set to continue for the next 5 years. So in terms of implementation, that's very important. And also another important point is cooperation. So the East African community, right? So that's Rwanda, Kenya, Uganda, Tanzania. I could be missing one. But they are working very well together in terms of getting the infrastructure on board. So they've got this project called the Standard Gauge Railway, right? That they're building from Kenya through to Rwanda and into Uganda, and Tanzania might be involved later, where they'll be able to transport those goods at a much cheaper rate and faster because it's the railway through those countries. So we're talking about that sort of implementation and cooperation and very deliberate execution of their plans.
Yeah.
That's what I think East Africa is getting right the most.
Certainly, there is a role in terms of lobbying more prudent policies in terms of the government regulation. But again, I'll draw the example on Nigeria, where some of the things that we're grappling with in terms of trying to understand the economy is that you tend to get situations where is the central bank independent? Is it not? Who's running the show? Is it the president? Is it these distinct issues? And yet fundamentally you're supposed to have a clear separation of church and state, right? In terms of central bank doing what it's supposed to do in carrying out its mandate, and government doing what it's supposed to do. But you tend to get statements from the president saying we're not going to devalue the currency, which is a bit odd though, right? Because it shouldn't be the president's call, but you tend to get these merging of forces, which ultimately tend to be a bit negative. But again, we turn to East Africa, where you almost see the pillar of, or rather the standard of where Africa should be going in terms of separation of some of these entities, and actually bringing about greater independence in terms of our policies.
So can you have something to add?
Yeah, just to add to that, Anthony made a very good point. It's so challenging right now for some companies operating within countries where the currencies are managed. So, for example, Shoprite in Zambia is paying the leases in dollars, like you mentioned, but then their revenues in kwacha. So it's a double whammy because their costs are increasing on the dollar side, but in terms of revenue, they're making less and less and less just because that currency is depreciating. And even with that revenue that they make in kwacha, it's very difficult to convert that to dollars. So it has become a really, really challenging environment in that case. And the liquidity constraints, so especially foreign exchange constraints in these commodities, has made it so difficult to operate. Nigeria comes up all the time, and when they were speaking, I'm like, I'm not going to give Nigeria as an example, but I'm forced to. Nigeria as an example. You'll see that there are companies that need to import, right? So it's either the imports have been banned by the central bank, not necessarily banned, but they won't give you foreign exchange for it. You know, so it's very hard to access it. And that's why you're seeing a lot of businesses struggling to operate in these economies, because you literally need dollars to operate and they're not being supplied.